We have our next guest joining us. One sector which has been in a bear market this year after a 3-year bull market is IT. Ankur Rudra is Executive Director, Technology and Telecom Research at JPMorgan and has, of course, tracked this sector for a really long time. Ankur, good morning. Thanks for joining us. Last quarter, the big chatter was just about margin and valuation. This time, I was reading that perhaps there would be concerns on top line itself. Are things looking really that bad, or is it still largely about margin? Your view on the IT stocks now?
Thank you, Anuj. I think this year, clearly, we have a lot of challenges for the IT sector. We began with some concerns about the demand back in May and June, when there was the first signs of macroeconomic weakness. And then, of course, like you said, there were margin pressures that every company has faced. I think with some of the negative surprises on inflation we've seen in the West and some profit warnings by leading global companies, the concern on growth and demand has really come back. Our perception is that so far the IT services companies have not probably seen this on their top line yet, perhaps not even on their order booking or signings. But the more leading indicator is the pipeline. And we think we'll begin to see this maybe in a few quarters out. Now, remember that IT services companies are late cyclical. So it might be some time when they reflect the current macroeconomic scenario. But from a conversation perspective, we are equally worried about the top line and the margins.
Equally worried about the top line and margins. So Q2 earnings season is upon us, Ankur. Do you expect any change in the margin guidance from some of these large cap companies like Infosys?
I think, both the last 2 quarters, we've seen very significant margin misses by a range of companies. Last quarter, I think, was an interesting quarter where every large cap IT services company missed their margins and margin expectation by a significant percentage. This time, perhaps, on a sequential basis, we don't expect that. I think there is an expectation that in general margins for the sector may not worsen significantly. But the real point is not, what happens sequentially. The real point is how long can these companies keep these very low margins? How long will it take for them to recover margins? And I think that's an important debate. Can these margins be recovered significantly? Can we go back to the margins of 2020, margins of 2021? And that's where we think there is a lot more structural pressures on the margin, both from the significant cost inflation that the sector has seen on offshore employee base, especially the younger employees less than 5 to 6 years of experience, on a very high US wage inflation, which is in many cases about 5% versus 2% for the last 30 years, and also returning travel cost and facility cost. So maybe not so much incremental margin pressure on a sequential basis, but the chance of margins to recover from here, let's say for F23 and F24, that's where we remain very, very concerned.
Okay, Ankur, since you did mention 2020 and 21, what about valuations? Because margins are back to pre-COVID levels, but valuations are still 35-40% higher compared to that. Do you think more reset is needed?
I agree. I think so. I agree with you. I think valuations remain very high, especially if you look at the long-term averages pre-COVID. We're still above 20 to 30%, like you said. I think that's the challenge with the IT industry right now. There is a potential for, there's an earning risk from demand, like we discussed. There is an earnings risk from margins, which might take much longer to recover. And valuations remain very high. For a significant proportion of the companies, especially some of the large companies, many of the mid-caps, valuations remain significantly high. And given we are going into a period of macroeconomic slowdown, we don't know how long that will be. This doesn't seem to be a great time for the sector. So I think we remain very concerned on valuations as well.
Ankur, hi, good morning. Prashant here. Have any of these companies presented at your conference, or are they, Ankur?
We have a lot of tech companies, tech services companies at our conference. Tech services companies haven't presented, but a lot of companies have been participating in our conference.
Okay, sure. No, the reason I say that because there are a lot of other conferences happening, and I was reading sort of what Infosys, for example, said a couple of weeks back at I think at a Credit Suisse event, and TCS recently, did something. The general indication seems to all of them are saying that large deal momentum etc. remains pretty strong, right? There has been really no postponement or anything like that. There was another comment that I read from one of these companies to say that, well, if you're going to see a postponement, it's largely going to be in the hardware segment, servers, etc., because that's easy to postpone, not software services. How do you kind of respond to that? And have you heard that kind of pushback from companies themselves? Your sense?
Sure. So thanks for the question. I think it's very interesting. I think what we think about is the relative cyclicality of different segments of tech spending. There is hardware, which tends to see the impact of a macroeconomics weakness first. There is enterprise software. We've seen a lot of enterprise software companies already giving out profit warnings in the last few weeks and months. And then there is services, which is is probably the most late cyclical of all of these three, where they see an impact after the hardware industry sees, and after the software industry sees. So in a way, for us, when I think about this, for me, I think hardware softness and slowdown is basically the first leading indicator that tech spending will get impacted. Like I said before, I don't think that any of these companies are seeing it so far, because if there is weakness next year, they'll probably see it closer to then. I mean, if you look at the last 4 downturns, IT services companies have taken a long time to perceive this. But that doesn't mean that it may not happen. So we remain equally concerned, despite in the short term, companies not seeing it. And in fact, we were expecting second quarter to be a relatively strong growth quarter. We'll have to see how these companies perform in Q3 and Q4, which have been traditionally relatively soft quarters from a seasonality perspective.
And will the Accenture numbers this week kind of be important to track, to gauge? Whether this softness is coming through or not, or you think?
I think so. I think.
Yeah.
Okay.
Go on.
No, I agree. I think Accenture numbers are very important. And, there is the guidance that Accenture gives for the August ending year for next year. I think that's an important metric to track to get a sense of incremental demand. There's also very important to see where the bookings are for Accenture. So it's important for the industry. Having said that, Accenture has been growing a lot faster than almost every IT services company of scale in the last 1.5 years, except maybe one company. And hence, even if Accenture does do really well, we'll have to see if it comes from consulting or technology outsourcing, and how much of that is relevant for the Indian IT companies.
I just had, a couple of more questions, if we can squeeze them in, Ankur. Stocks like Tata Elxsi have had a dream run, and despite premium valuations, these stocks are still up about 50% year to date. You have an underweight on that stock. Just want to understand, do you think that the trajectory will continue to be northwards from here, despite all the challenges that we've seen?
I think I can't comment on stock specifics, so won't be able to comment on one company. But what I would say is, from a fundamental perspective on the engineering, research and development sector, there are two things about the sector. It is probably going to grow structurally faster than the broader IT services space because it's less penetrated and there is a huge amount of digitization. And also, they're also very cyclical. So if there is a slowdown, they might get impacted faster. You might see an impact perhaps in F24, perhaps in CY23. So those are the two interesting factors about the engineering services companies which you'll have to contend with. And if some of these engineering services companies, I think most of them on an average, are a lot more expensive than the broader IT services peers to bake in the long structural story. So if there is a slowdown, it could drive a significant negative, surprise on earnings.
Ankur, one last question from my side. Did the recent FedEx stock fall and the warning from FedEx sort of also come into a picture in terms, because that's a large sort of company in terms of what the US economy is doing. I believe it's also a client for a couple of large IT companies as well. Any thoughts here?
I think the FedEx warning is interesting, like you said, because about what it says about the nature of demand and nature of spending. It could have a ripple effect on the IT services companies it's a client of. So I think both of those factors are important. I mean, from us as an outsider, we just definitely view this as a potential trigger. So like I said, there have been profit warnings in software and also profit warnings in many clients. This is clearly one of the clients which is warning. So we would be concerned about, to an extent, the tech spending at clients such as this company. We'd also be concerned about how this spreads because we've seen some profit warnings come through. And that would be probably a source of worry. It also depends on how that particular company is choosing to decide between outsourcing companies and non-outsourcing companies in deciding to look at and realign its tech spend.
Ankur, always a pleasure to talk to you. Thanks a lot for joining us, and have a good summit in Delhi. Thanks for joining us. That's Ankur Rudra from JPMorgan. They have been negative on IT, of course. The pre-open has settled, by the way, 50 point lower on Nifty, so not as much as